right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at EPD, Enterprise Products Partners. A pretty interesting company, not technically a common stock. It's something called a Master Limited Partnership, first one of that particular structure that we've ever covered on the channel. I've done some valuations of Master Limited Partnerships before, even owned one before. This company was recommended by a viewer on the channel, so I hope that they're satisfied with my overall description and discussion of some of the specifics when it comes to investing in that type of structure, which we'll definitely get into in just a minute. EPD themselves, Enterprise Products, they are a pipeline company, natural gas, crude oil, natural gas liquids, and other petrochemicals that they pipe through their pipeline network, as we can kind of see on this map, as well as they provide a variety of other energy services, storage, tanks, trucks, and things of that nature. So before we get into Enterprise Products specifically, however, we will take a look at our watch list here. I don't actually have a whole lot of specifics on the watch list to discuss, but I did want to kind of discuss a few specific things, like I said, related to the Master Limited Partnership before getting into the evaluation itself. While I am looking at the watch list right here, I would say that I am kind of on the search for a lot of new tickers to be valuing in the next few valuations on the channel. I have a small short list of companies that I've put together from some 13Fs as they've been coming out in the most recent future, or in the most recent past, in the last few days, as well as like I said, a variety of recommendations from the channel. So if you want to possibly have a company of your own choosing be valued on this channel, you can suggest it both in the comments below, though you better be liking the video if you're suggesting videos for me to value, as well as you can join the Discord. The link is in the description below, as well as in the pinned comment in the chat, where we have discussions about the market, portfolios, company analysis, major investors, and even sharing a few memes with each other here and there. So go ahead and join the Discord, and you can put your recommendations there. So like I said, before we get into Enterprise Products specifically, I kind of wanted to cover Master Limited Partnership structure itself and kind of describe a little bit about what makes it different from a normal stock. It is somewhat similar, I guess you could say, to a REIT, which I did also value another one of those for the first time on this channel recently. But it also has some pretty major differences. I would say it's similar in that it doesn't pay normal corporate taxes. And so there is a different tax setup on the shareholders end rather than on the corporation end, as well as there is also a larger amount of dividends being paid out, like there is with REITs. However, unlike with REITs, they're not technically called dividends, they're what are called distributions. So getting into like this article from Investopedia just kind of describes some of the specific differences. MLPs, first of all, it stands for Master Limited Partnership, so it's technically a partnership, not a normal corporation. A partnership has two separate types of partners. There's the general partners, which are the people who basically run the operation, the managers, so to speak. And then there's the limited partners, which are the people, so the shareholders, essentially. Now, getting into some of the more specifics, we're going to talk about the tax complications of owning an MLP. An MLP is treated as a limited partnership for tax purposes, which is significant tax advantage to investors. As pass-through or flow-through tax structure, all profits and losses are passed through to limited partners. The MLP itself pays no taxes on its revenues, as most incorporated businesses do. Instead, limited partners pay income taxes only on their portion of MLP's earnings. Further, deductions such as depreciation and depletion also pass through to the limited partner. Limited partners can use these deductions to reduce their taxable income. MLPs must also pay out at least 90% of their qualifying income, and their qualifying income must, for a majority of it, come from specific industries such as exploration, production, transportation, or natural resources and real estate. Hence why you do see MLPs in a lot of real estate companies, as well as things like pipeline, the one we're doing here today. So that's just part of the nature of it. For a good example, for the other MLP that I actually myself owned in the past was actually an MLP that was more on the real estate end of things, though they also operated certain amusement parks. So they did have, for example, some revenue that wasn't part of the real estate, but they had set up the structuring so that the vast majority of the revenue came from the real estate. So that's basically just kind of how it works. Now, obviously, like I said, the one we're looking at today is an oil and gas pipeline midstream industry level thing. So that one's part of the production and transportation of natural resources. So it qualifies under that specific circumstances. Now, a few more of the specific details about the deferred taxes and the capital gains tax rate. Quarterly distributions from the MLP are not unlike quarterly stock dividends. However, a portion of the distribution is treated as return of capital as opposed to dividend income. So the unit holder does not pay income taxes on the distribution. Instead, the distribution reduces the cost basis of the units. Distributions remain tax deferred until unit holders sell their interest in the MLP. Then the difference between the cost basis and sales price is taxed at a combination of the ordinary income tax rate on the return on capital and the capital gains tax rate on the appreciation of the unit since purchase. So to explain what this means, because there's a whole lot there, and really there's a whole lot more to this article, but I'm just going to give the basic overview of what it means. It means that essentially you do not pay normal taxes through the corporation on this particular stock, and instead you pay taxes on the dividends, which means that there is going to be a certain benefit for people in lower tax brackets, for people who have larger amounts of dividend income. This is generally true of dividend stocks across the board, which is that if you're in a lower tax bracket, dividend stocks are generally going to be a little bit more beneficial for you than somebody who's in a higher tax bracket. That will be equally true for a master limited partnership. However, there's also the as it said, the change in the cost basis that occurs over the return of capital. What this means is that you get even further of a tax deferment on that dividend income in the short run, but it means that you're punished if you sell your stock in the short run as well. And the reason why is because it lowers the cost basis of your actual holding, which means that the larger percentage of your sold value once you do sell units is going to be capital appreciation, and thus going to have capital gains. So essentially what it means is that it rewards people with lower tax brackets, but it also heavily rewards people who are holding it for longer periods of time. It's typically, the rule of thumb is at least 5 years or so, and then that benefit starts to really accrue. But if you sell in the short term and take longer, taking a higher short term capital gains rate over a longer term capital gains rate, it's going to have a much more detrimental effect. So essentially, that's how master limited partnerships work. They're high dividend income stocks, and they reward people with relatively low tax brackets, and also people with very long time horizons. And that very long time horizon part is key. Obviously that's true of all stocks in a general sense, but with master limited partnerships, it's especially true. So anyway, getting into some company specific info as we normally do before we get into the company itself. The company was founded in 1968. and is a United States company with United States dollar as its main currency. I have its main links to its main websites here. It actually currently has a co-CEO structure with James Teague and Randall Fowler, both of them taking up that position in 2020. I believe it was Randall Fowler who had been a CEO prior to that. I couldn't really find too much specifics to find out if Mr. Fowler had done some things to merit him essentially kind of taking, I guess you could say, a partial demotion to co-CEO over main CEO. So I couldn't really figure out exactly what the deal is with that, but interesting to say they have a co-CEO structure. They both did actually join the company in 1999. As I'd already said, they are part of the midstream oil and gas industry, part of specifically the Master Limited Partnership grouping of that, because there is a decent amount of MLPs in that specifically, so you could focus on them over I guess you could say the midstream and oil and gas industry as a whole. They have a wide variety of customers and suppliers, so I didn't really focus in on that. They do have a few more specific competitors to note: KMI, ET, MMP, and DCP. These last few are actually other MLPs, so you could take a look at other midstream oil and gas MLPs kind of in the same industry. They did very much recently report their numbers, so I did put in an approximation for their next reporting date. It is an approximation, just 3 months after the most recent report date, so I'm not 100% sure this is when they're going to report the numbers, but that's when I would estimate that that's going to happen. And in their filings, I couldn't really find specifics on revenue guidance for them. However, on Yahoo, there is revenue numbers from the analysts with an expectation of about a 32 to 33% increase in overall revenues in 2022, with 8 analysts projecting that, and another 3% or so in 2023, 9 analysts projecting that. And that equates for them to $2.51 of adjusted EPS, according to 17 analysts in 2022, and then $2.51 in 2023, according to 19 analysts. The trailing 12-month dividend or distribution, as we call them with this particular company, was $1.86. And the current forward dividend based off the most recent distribution is $1.99, which equates to just under a 7% distribution yield for the next year or so, which is very, very large yield. But as we were saying, that they are, according to the structure, are required to pay out approximately 90% of their payable distributable earnings. And so you would expect there to be pretty high yields on that. Like I said, that's going to be the majority of the cost of equity for the company. They do also currently have a buyback authorized. $1.5 billion of buyback is authorized, which equates to another 2.5%. So between the two, you can say that's about 9.5%. The buyback does not have any expiration on it, and it does seem that they've been relatively selective and slow moving with their buyback, because they actually started this buyback back in 2019, and they've only done $500 million or so in the few years since then. So they're being a little bit more judicious with it, and I wouldn't necessarily expect that to go very, very quickly. Now, coming down here, you can see the held insider percentage is currently 32 to 33%. It's increased ever so slightly in the last 6 months, but not very much. But the real note is that it's just that large, 32 to 33%, which I actually did pull open their page on Ticker, where you can get the ownership page, and actually comes down to here. You can see more of the specifics on that, because I was like, wow, what's going on with that? It turns out the 32% being held is by one specific individual, Randa Duncan Williams, which is an executive that has worked with their company and has family ties with the company going back quite a long while. So I would say that this is an inside holding that is likely to be maintained, and it's not really likely to go anywhere. This person is likely benefiting from exactly what I was talking about, where the longer you hold the units, the better your tax deferment on the distributions become. And so she basically is in a situation that has no reason to be selling out the majority of her shares. In fact, if you look over the insider record over the last several years, typically speaking, she's buying shares more than anything else. So 27% of the shares, 28% or so, being held by institutions. A very, very small institutional holding, especially for such a large company, has partially to do, I think, with the overall lowering of institutional holdings in the oil and gas industries over the last couple of years, according to changes in the ESG requirements by large institutions such as BlackRock. So, I mean, that creates opportunities for other investors. So, hey, nothing to be a problem there. It's much better to be in a company when there isn't large institutional holdings, and instead hold it all the way through to the point where the institutions have started buying up the shares themselves. Not to mention, it means also that shareholders who actually use their shares to vote for things actually stand a chance of perhaps having their voice be heard in a more democratic sense, rather than it just being the large institutional holders who each hold like 10% of the shares, and then at the end of the day it's really just like 5 or 6 people making the decisions. Admittedly, we do have that one person holding 32% of the shares, so I guess you could say that the corporate structure still isn't that democratic for different reasons. But I guess I'm more interested in having insiders have a large share of the vote than I am institutions. That's my own personal bias, I guess you could say. Only 1% or so of the current float is being shorted, which is significantly higher than the short outstanding, but obviously it's still about 1% or so, so no real amount to be noted there. Not exactly creating a floor in the pricing for us at this time. Short ratio being 2.5 days, and the average 3-month volume being 6.3 million shares, versus the last 10 days it's been about 4.5 million or so. So there has been a little bit weakness in the short-term movement of the stock. So now we can get into the earnings deck. There's a few things I kind of wanted to show specifically that they had in here. There's a few things both in the earnings deck, and then they also had an investor presentation, which is a very large presentation, but we're going to try to just skim through to show a few specific things. Let's see, getting into here, firstly, I mean, I guess they show their free cash flow bridge for the last 2 months or so, relative to what their cash balances were in 6/30 last year, showing that they've had pretty large amounts of their cash flow to operations, but they've also had a significant amount of business combinations. So you can see the 3.2 billion here, as well as it's in positive and negative, because they're trying to show the cash that they have available for distributions prior to the combination. So they kind of put it out here, which is why you see the 3.2 in both locations here. Technically, they're netting out against each other, but either way, kind of showing the overall cash flow activity of the last 2 months, and then also showing the growth opportunities they have over the next 2 years in total dollar amounts, as well as a variety of projects over the next few years, even beyond that into 2024 and 2025. I don't think there was too much more in this page that I was going to show. Yeah, the rest of the things I was interested in showing were over here in their much larger investor presentation, which is 63 pages. So we're really only going to take a look at a few of the pages in here. But if you are in any way interested in the gas industries, all of the gas industries, natural gas, crude oil, petrochemicals in general, they actually have a lot of really useful information in here, but we're not really going to break down too much of it specifically. As I kind of pointed out this map when we first started the stream, showing the distribution of all of their pipelines, not to mention all of their storage facilities, as well as the docking and terminal facilities that they have across the Texas coastline, and not to mention other areas in the south. Coming down here, they talk a little bit about the record average return on capital of about 12%. I think my number is a little bit lower than that, but different people measure capital and returns on capital in slightly different ways. Talking about their relatively good credit rating, which I actually compared that with the ratings that I get with the synthetic rating estimation, and I find that actually the rating should be slightly higher than that, maybe 1 or 2 classes above that. And so what that tells me is that either A, they're pretty well primed for possibly getting an upgrade, which is always a good thing for the stock when it happens, or possibly that just means their cash flows will actually just come in a little bit better than was expected for their current credit rating, which means their stock price might remain a little bit suppressed, but then the cash flows that accrue to the holders of said stock might be a little bit better. So in either situation, if their current credit rating is not as good as what we believe they can operate at, that's always a good thing for the stockholder itself. And then they themselves talk about the fact that 32% of the common units are owned by management, as we had talked about with Miss Randa Williams. So also getting down into this other page down here, they talk about just the overall usage for the variety of products that they move through their pipelines, which really, I mean, that's not really something that necessarily needs to be pointed out. Most people are pretty clear on just how useful the vast majority of petrochemicals are in a lot of downstream products. So yeah, obviously they have a huge effect on overall economic factors. And then there was a few other specific things I wanted to point out in this thing. Obviously, they talk about the overall growth in energy needs over the last several decades, and then the overall timelines people are projecting for a supposed timeline to net zero by 2050, and how that doesn't really construe with the overall projections of things. Essentially, they're saying that most people's timelines have to be pushed outward. There's no real way for them to actually move towards the scenarios that they are arguing for specifically focusing only on the IEA's oil demand scenarios, as they say right here, stated policies as they currently lie, showing a decent growth in overall demands, and then the announced pledges based off of specific political groupings around, I think that's mostly just the United States and Europe, doesn't even really focus on the entire world. This shows what the demand would look like under those scenarios, but to actually achieve a net zero scenario, we would have to dramatically cut the overall oil demands, which is just not likely to go, which really that's just them trying to suggest that the demand for their product is not likely to go anywhere. Like I said, there's actually tons of more information basically on that industry in here. I wasn't really going to get into too much of the specifics of that. I'm really just going to hop into the numbers. I did want to come down here to show that their ownership structure that they had put together these little graphs for, showing that between the ownerships that they have by management, and the various other groups and partnerships, corporations and pensions versus the Epcot and affiliates, showing that the vast majority of their unit base is essentially retailers as well as management rather than large institutions. And then they also show the disbursement of unit ownership by length, which I thought was really useful. I wish more companies would give this type of information. And you can see that, as they show here, 51% of units have been held for 5+ years. So you can see that the vast majority of the ownership of the company is actually owning it in line with what you would expect for people in an MLP structure, that they're relying on the tax deferment for the overall distributions. And that means that the management and the ownership are pretty well aligned with each other because of the fact that they are all long-term holders together. So with that, we can get into EPD and the financial history and numbers specifically. We'll start with the segmentation of the company, being that they're in the oil distribution industry. I'm giving them an unlevered beta of 0.78. And we have sales capital expectations for the industry of 0.46 with an adjusted net margin in the most recent year of 14.95%. Operating entirely in the United States, I give them a pretty low equity risk premium. That brings them with a debt to equity ratio of 47% to a levered beta of 1.15, and that brings them to a cost of equity of 8.91%. We have a weighted average cost of capital of just under 7.5%, coming off the back of their interest rate weighted of around 4.4%, which is at 27.1 billion or so in total debt, including lease liabilities, at a weighted average maturity of 17 years. So not the greatest of interest rates, but pretty decent interest rate, especially considering it's at such a long maturity. Really good to see such a long maturity. And then I did take the interest rate that they have here and subtracted out the current 10-year yield, which gets us 1.48%. And that's the spread that I was talking about that determines the overall credit rating that we might expect for the company. So they're saying that they're a BBB credit rating, but if we come over here to the grouping, 1.48% falls between 1.33 and 1.18, which means according to the overall spread on their interest rates, I would actually expect them to possibly get an A3 rating perhaps. So that's kind of what I meant when I was saying that I think that they possibly actually are due for an upgrade to their credit rating, or possibly they just accrue better cash flows on net with my expectations than their credit rating otherwise would, which means that the returns should be outsized, whether that's through distributions or eventual appreciation. So getting into the 10-year history of the financials of the company, we can take a look at that. You can see that in 2012 they had 42.5 billion or so in revenues, and then in 2021 they had 40.8 billion. So you can see that really on net between the 10 years they haven't hardly moved in overall revenues. There has been pretty large ups and downs in the natural gas prices, which is the commodity that their revenues is most reliant on. I actually did do a commodity correlation for enterprise products against natural gas, which we'll get into after I finish looking at these numbers. So you can see that overall, there's been a pretty large shift there, that they did actually have a downward swing all the way down to a low of 23 billion or so in 2016, after having a dramatic downward move of 44% in 2015 and another 15% in 2016, and then prices moved back up just as rapidly all the way through 2018 up to 2019 to a high point of 36.5 billion, and then they came back down to 27 billion in 2020, and then a spike back up to 40.8 billion in 2021. So overall, a pretty chaotic set of revenues over the 10-year period to have basically gone nowhere. We can see that their gross margins on average over the entire time frame have been about 13%. We can compare that to kind of what the margins were, for example, during the high peak period that they had in 2014. So before their revenues had crashed, they actually had margins of really just only about 8%, which is pretty interesting to consider versus the relatively higher margins that they had after the prices crashed. So that's a little bit interesting to see. I do believe that comes off of the back of a pretty significant changeover in assets that they had during the period. Yeah, they did discard a significant amount of assets while also buying up different assets. So they were changing up their overall corporate structure by making pretty large combinations with their business, and probably getting rid of large overlaps within the operational costs of the business. So even though their revenues collapsed, they were able to shake up their cost structures and rebase their gross margins into a teen level. And then we can see that their gross margins have bumped up and down a little bit during the 2020 drop as well, but then came back down to this teen point around in 2021. Coming down to the net income margins prior to that's right, they didn't have development costs. I thought they had forgot thinking that they had development costs, thinking of another company I was valuing. Coming down to the net margin, you can see that they have just as much of a chaotic line through some of the years, but it remains a little bit more stable than the overall gross margins, on average staying at about a 10% average through the entire time frame, moving from lower, more single digits up through 2015 up into more mid double digits up through 2019 and 2020, and then ending around 11% in 2021, being an average of about 13% for the last 3 years, but again more like an average of 10% over the entire time frame. Coming down to the cash flows, I can see that there is pretty significant capital expenditures each year, to be backed up just by pretty heavily large amounts of depreciation against each year. So really the question is on net overall in any given year. How much are they actually reinvesting in the business? If we take into account all forms of investment, including the change in working capital, which is a major form of investment that people often discount. And the reason why I bring that up is because we did actually have a pretty significant change in working capital in 2021 versus a relatively stable changeover for most of the years prior to that. We can see that the adjusted net capex, which takes all three of those things into mind, you can see moving from kind of an average for the first 5 years of a total adjusted net capex of 2.6 billion per year to, for the last 5 years or so, it's been more like 1.2 billion. And then it was in fact negative if you're including the working capital in 2021. So effectively they were liquidating in 2021. And this comes off the back again that we had talked in their earnings deck about the most recent 6 months. They've actually put in a decent amount of new capex, not to mention also business combinations. They weren't combining into that, not to mention also the larger plans for further capex in those other projects that they had through 2024 and 2025. So even though they have had relatively lower net capital expenditures and reinvestments in their business in the last 5 years compared to the 5 years prior to that, we expect them to pick that back up in the next 5 years for the projection period. So now taking a look at the free cash flows to equity over the entire time frame, you'll see for the first 5 years of the historic period, they had an average of 3.1 billion or so in cash flows that they could pay out to their shareholders. And then the amount that they did pay out to their shareholders was about 1.3 billion. So definitely not overpaying the shareholders for the first 5 year period. For the second 5 year period, it was 4.2 billion or so on average that they could have paid out to their shareholders after including all free cash flows, capital expenditures, and issuances of debt and equity. And then the amount that they could pay out to their share, or the amount that they did pay out to their shareholders, was 3.5 billion. So a huge step up in the total amounts being paid out to their shareholders in the next 5 years, but still not overpaying their shareholders, still a decent amount of buffer to the overall cash flows to equity. And if we come up, just taking a look at the net debt issuance line, because I'm kind of curious about that. So let's see how much of the cash flows to equity was off of the back of raising debt, because it looks like that's pretty significant. So 3.6 billion or so over the entire 10-year time frame is the average of the amount of cash flows they could have paid to their shareholders, and the amount that they were raising through debt and share issuance over the entire time frame is 2.3 billion. So a pretty large majority of the cash flow. It means that if we didn't issue any new debt over the entire 10-year period, it would have been more like 1.5 billion per year that they could have paid out, which means on net, if they weren't issuing debt, they would actually probably be overpaying their shareholders. However, that's not necessarily to say that's a problem. That's not necessarily to say that they are using debt to finance all these payments to the shareholders. That's not at all the case, because they've also been obviously making huge investments in their business. That cash hasn't just been done specifically for a reason. It's also been done for the capex reason. So I just brought that up because I was kind of curious to see how much of the cash flow is reliant on that in the short run. But that's not necessarily to say that it is in the long run. For example, if we just take a look at maybe the most recent 5 years, 1.5 billion in amounts there versus 4.2 billion. So in the most recent year, it's only maybe about a third of it that came from the debt issuances versus 2/3 for the entire time frame. So you could say that the leverage they were taking on in the first 5 years is actually starting to show fruits in the next 5 years with that logic. So coming down to the returns on invested capital, you can kind of see what I was talking about in the presentation, that I had said I didn't think the 12% line was entirely too accurate. Yeah. Careful, Fuhat, with the cursing. It kind of gave me a little warning thing about that. I gave it an approval, but YouTube has like automatic filters and stuff for cursing and stuff like that. But yeah, doing EPD. Thought I'd get this one added to the watch list. Welcome to the stream. If you guys are watching and if you haven't already, please give us a like. It'd be very much appreciated. So for the first 5 years of the historic time frame, the average returns on invested capital, as I measure it, a little over 9%. In the next 5 years, it came up to a little under 10% or so. And you can see that that is indeed lower than the 12% that they were saying that they had achieved, which, like I said, they probably are using a slightly different calculation for the return number that goes into the capital. We might be using relatively similar capital numbers, but there are different ways to come up with these numbers. The return on equity, however, is significantly higher than that, coming in at 14.5% for the first 5 years and a little over 16% for the next 5 years. So the overall leverage that they take on does seem to have a pretty solid effect on the overall returns. And then coming in with the fact of those really large distributions to shareholders and the amount of leverage is being taken on, we can take finally a look at the balance sheet. You can see that they didn't really hold only hardly any cash at all for the first 5 years, averaging about 46 million in the first 5 years. Up to the next 5 years or so, there's been much larger amounts of cash on hand, 912 million on average for this 5 years. Though obviously that's mostly off the back of these most recent couple years where there's really large amounts of cash on hand, 2.8 billion in the most recent year, though obviously they don't currently have 2.8 billion on hand because they did put a decent amount of that cash to work in the business combination in the last 6 months. So just because it says 2.8 billion here doesn't mean you should think that they have 2.8 billion right now. This is the fiscal 2021 numbers, as I usually do my projections off of. I can see that their inventories have also been growing pretty significantly over time. They didn't really grow too much in the first 5 years, averaging 1.2 billion or so, and then they definitely started to explode more dramatically in the next 5 years, reaching a peak in 2020. So they've come down pretty significantly since then, about 20% down. So that's somewhat good to see. Overall current assets, though, almost tripling over the entire 10-year time frame, up to 13.2 billion. And comparing that, for example, against the current liabilities of 11.6 billion, which the current liabilities haven't even doubled over the entire time frame. So, like, for example, comparing the current assets to the current liabilities in 2012, well, there was actually more current liabilities than there were current assets. So in terms of the overall operating assets of the business, they've done a good job of improving their stance and making it so that they actually have a net positive working capital. Not net positive working capital after adjusting for cash, which would be even better, but still a much better stance as far as their current assets and current liabilities. They have massively increased their long-term debt as well. That has doubled over the entire 10-year time frame. So we'll see whether or not in terms of the total liabilities and assets, if that's in scope of it, the total assets went from 36 billion to 67 billion in 2021. So that didn't even double over that entire time frame, while the total liabilities did just under double over the entire time frame as well. So yeah, their assets haven't been growing as fast as their overall liabilities. Thanks. Our thoughts on the new green things they should be good for 2025. You're talking about the new projects that they have underway for 2024 and 2025. I did talk about that a little bit earlier. I didn't get into the specifics about like which parts of the industries they were getting into. You're saying that talking about more of the green projects they're working on. I'm pretty good to just see that they're making really large investments in general. They have a pretty good growth path and pipeline of projects both over this year, next year, and 24 and through 2025, which they, for example, were saying that for 2022 they're expecting about 2 billion in growth capital. I'm expecting net growth capital of at least 1.5 to 2 billion through 2025 and 2026, but we'll get into that when I get into the projections. Shareholders equity. So with the liabilities growing faster than the assets, the question is, how is that actually affecting with the overall equity? And I would say that the shareholders equity held up pretty strong. That has also basically doubled over the entire time frame. So while the assets didn't grow as fast as the liabilities, we still get the shareholders equity growing basically just as fast as the liabilities grew, which is pretty good to see. So it basically means that even though they've been taking on a pretty significant amount of liabilities in the last 10 years, the actual value of the book for the shareholders themselves has improved pretty significantly as well. So we can take a look also at the sales capital ratio, which kind of takes into account both the changeover in the sales over the 10-year time frame, not to mention the massive amounts of investments in the business and the huge growth in liabilities as well. As we've talked about, all three of those factors would kind of come into this number in a pretty dramatic way. And you can see that it has been pretty dramatic. You can see that, for example, they actually had a sales capital ratio higher than 1 for the first 3 years before they had the huge drop in sales in 2015, which is pretty crazy to see for such a high capital intense business to actually achieve a sales capital ratio higher than 1. What that tells me is that for these few years right here, they probably had massive underinvestment relative to the high prices that they were experiencing at the time. And so when the prices collapsed, they probably were unable to sustain themselves and had to reshift their capital structure, which we did see in the cash flow line. They did spin off some assets in 2016, but they had much larger pickup of assets in 2015 and 2017. So you can see that the sales capital ratio had to readjust after the crash in the revenues that they experienced in 2015. Ever since then, it started to come back more into a little bit of a stable ground, hovering between this kind of 0.7 range and 0.5 range, averaging about 0.65 or so over the last 5 years. So as we get into the valuation itself, I'm going to actually do a little bit of a side piece to show my correlation against the commodity modeling for the revenues. Coming over to my spreadsheet for natural gas, you can see what the natural gas prices have looked like ever since 1996. It goes back to, I believe, or so. You can see there isn't really a very consistent trend upward. This isn't the type of base commodity that has a little bit more of a specific correlation with the growth of the economy and the growth of the money supply specifically, since it itself, while it is a commodity against itself, it is not exactly a commodity if you think of the energy space a little bit more broadly, which is to say that natural gas and oil and coal and all the other energy forms and in many other ways are competing against each other. And so in a certain way that kind of decommoditizes the way in which the price movements work, which is how you get a little bit more of this kind of volatile up and down kind of pattern in the overall commodity. So what that means essentially, the reason why I'm bringing that up is that with some of the other commodities that I've done price correlations against, I've used the growth of the money supply as a guide for projections of potential future prices, and then I've often balanced that against a statistical regression of past prices. For natural gas, I can't really come up with any good methodology for making projections for future prices. So all I have to rely on is a regression against the past prices. So that's basically what I'm going to do is that I have all those. I have the yearly natural gas prices for basically the time frame we saw in this chart right here. This is the year-end prices. I list them in order, and I come up with the quartiles ranges. So basically the lowest quartile average of natural gas prices is possibly $2.10. The highest quartile of prices, $8.47. You can see like the average between all these quartile prices is about $4.50. And then it also, let's see, what is it currently trading at right now? It's currently trading, is it currently trading about 9.18? Is that accurate, or do I need to fix something right there? Hold on a second. Almost feel like I need to check that. It moves up and down so much, I'm never really sure where it is at any point in the month this year. Yeah, it is about 9:20 right now. Jesus, that's crazy. I mean, I knew it was still probably right, but in my mind it's still just kind of crazy. Oh, and then also I also took an average of the price over the last year, which the average for the last year has been $5.60. So multiple ways to kind of think about historic prices of natural gas. I also took a correlation of the prices of natural gas at year end against the price of EPD at year end. Turns out there is no positive correlation between the price of EPD and the price of natural gas specifically. There's in fact a negative correlation of 32 to 33%. There is, however, a very strong positive correlation of the revenues of EPD against natural gas, which is what we typically do here is we correlate against the revenues. There's about a 60% correlation between revenues of EPD and natural gas, which is to say that when natural gas prices crash, the revenues of EPD are going to crash. For the projections I'm using those quartile ranges. I have in the worst case scenario, we're using $2.86. Best case scenario, we're using $8.47. The mid case scenario, we're using $4.50. And then on either side, the second and fourth case models, $3.82 and $5.26 respectively. Those get me ranges of revenues of anywhere from 33.1 billion to possibly a high of 71.3 billion. And so those are going to be the revenues I use for the future projections. So coming over to the projections, you can take a look at that. 33.1 all the way up to 71.3. On expected basis, we're seeing 48.3 billion in revenues in 2026. That's again against the 40.1 billion that they currently have. And to compare that, for example, against the analyst projections, the analyst projections on average for this year is 54 billion in revenues and 56 billion next year. So 54 billion in revenues is what's expected this year, and technically I'm projecting 42 billion and 56 billion for next year, while I'm projecting something in the range of like 44 billion. And you might say, well, okay, well, why are you projecting price of the revenues so low? Well, firstly, it's because my spreadsheet model is a little bit limited. I only have so many slots in which I can fit things, so I kind of have to make decisions about where I want to even things out. And I'm essentially going to ignore some really, really high revenues in the short run off of the expectation that I believe natural gas prices will probably crash at some point. I don't know when they're going to crash. I don't think they're necessarily going to crash this year. I don't even think they're necessarily going to crash next year. Maybe it'll be 2024 when they crash or something. But on it, undoubtedly, I think natural gas prices are likely to crash back down maybe to this kind of like mid-level that we had seen for quite a long time. So that's kind of what I'm projecting into these revenues here. I do think on net we'll probably maybe end up at, like I said, about 48%, 48.3 billion or so in the 5-year forward period. But in this kind of midterm in between period, I have no real idea where the natural gas prices are going to be specifically. So I'm really just kind of allowing a smooth growth from the 2021 numbers up to that numbers. I very much think that they very well might grow pretty significantly and then come back down pretty significantly. They might even be pretty significantly below it for a year or two as well. There might be a full S curve in here, in my opinion. It very well might be that we have 2022 numbers that are, as they said, 50 to 60 billion or something, and then maybe they crash all the way back down to 35 billion in 2023, and then they stay at that level for the first few years, and then they come all the way back up, then they shoot all the way back up to 48 billion in the last year. You know, I have no idea exactly what the natural gas prices are going to be. I'm just guessing based off of where I think they will be 5 years from now. That's basically it. We're keeping it that simple. We're not really going to make any real assumptions about the short term, even though, yes, like I said, yeah, the Yahoo assumptions assume a much rosier next year and this year for natural gas prices. We're assuming they might crash tomorrow, even though, like I said, I very much don't think they will. We just think that it might be about 48.3 in 5 years, and that's where we're going to stick it. Likewise with margins, over a lot of my more recent valuations, I've projected pretty large crashes in revenues and pretty large crashes in margins. You know, like I said, I'm not including that huge bump in revenues in the short run. I'm also not going to punish their margins in the short run either, like I've been doing with lots of other companies. Since this company's profits is entirely based off of a commodity price that I just openly admitted I have no real solid way of projecting, other than like I said, relying on past prices the way I just did. So I'm just going to allow it to go smoothly from the 3-year average it's currently at, which is 12 to 13%, which is actually higher than the most recent year. So that may counteract some of the lower revenues I put in place there. We're just going to have it smoothly go towards our terminal margins, which on an expected basis is about 10 to 10.5% because of a range we have of 5 to 14%, leaning towards 11. So yeah, it's a relatively simplistic valuation for this one. We're relying entirely on that commodity price correlation, and we're doing basically no major assumptions in the short run, just smooth straight line trends towards our long-term numbers. But that's about as confident as I feel I can be with a company like this. Now, coming down to the sales to capital ratio, which is the other major assumption that comes into play for the valuation. As we had said, they are currently about 0.76, and they've kind of been hovering this kind of mid 0.65 range, which is relatively in line, as we had said, with the things we had seen relatively for their industry, which is to say that they have currently a relatively high sales capital ratio against their industry, but they also currently have a little bit of a lower margin than their industry. So I like that balance on net, which means I actually do want them to stay higher than their industry, but perhaps maybe not continuing to go higher since they're already higher than their industry. So I have it on assumption that they will basically kind of stay about the same sales capital ratio they're currently at. And I am allowing it to stay at the same sales capital ratio rather than coming back down to the average, because I'm allowing that to be a little bit more of a gift to them because of, like I said, the lack of the short-term revenues being adjusted for. So we're going to assume that they're slightly more capital efficient, essentially, to make up for it. And with that, the only other major assumption is the debt assumption, which they currently have a debt to equity ratio of 47%. So I just made it a range between 30% to 100%, leaning towards 50, which gets me an expected value of 62%. So we do assume that they'll take on a decent amount more debt in the short term, or their market cap will come down in the short term, because these are market weights of debt and equity. So either of those things can contribute to the increase in the debt to equity ratio, or a little bit of both on net. So that's going to be it for the valuation of EPD. With that all together, we can come over to the summary page. EPD, Enterprise Products Partners, MLP, midstream oil gas player. The current U.S. Treasury is selling for, before I get started with this, if you are watching, whether live or on the replay, please give us a like. It'd be very much appreciated if you'd like the stream. That way we can get more people attracted to the content, and also subscribe to the channel if you're not already subscribed. That way you get notifications when I go live. So Enterprise Products Partners, U.S. Treasury is currently selling for 2.8% or so. Mature market equity risk premium that I have for markets currently is 5.25%, and then I come up to a discount rate for EPD of 8.92%. The dividend yield that they currently have, or distribution yield, is 6.96%, which I have This 78% up here is kind of just to point out something a little bit more specific, which is to say that the distribution yield is actually 78% of the overall discount rate. I'll get into kind of what that means in here in just a minute, but that's kind of going to be relevant in a second. So 5 years ago, they had sales of 23 billion or so. In the most recent year, it was 40.8 billion. That gave them sales growth of 12% per year on a compounded basis for the last 5 years. Sales capital ratio in the most recent 3 years on average has been 0.64 against their industrial expectation of 0.46. The returns on invested capital they've had most recently on average has been about 9.5%. And they have a debt to equity ratio of 47.5% or so. Their default risk is a little over 1% in the most recent year, and the profit margins over the last 3 years on average has been about 13% compared to the industrial average for the most recent year of 14.95% or so. That gave them profit of 4.5 billion or so in the most recent year against a currently selling price of $27.30. The probability distribution that we use is a completely flat uniform distribution, which is the distribution that we use when we're using a commodity price correlation methodology, because we try to not basically we try to have as agnostic of an approach when it comes to the price of the commodity that we're relying on for our revenues. And so with that, we do have natural gas prices at anywhere from $2.86 in the worst case scenario to possibly $8.47 in the best case scenario in the 5-year forward period. On expected basis of the distribution, we get $5.09. And with that, we end up with revenue expectations of anywhere from 33.1 billion in the worst case scenario to possibly 71.3 billion in the best case scenario. On an expected basis, we come up with 48.3 billion or so. And that comes out to sales growth of approximately 3% or so on an expected basis over the entire 5-year period, which, like I said, I actually expect the revenues to probably be very chaotic. They will likely spike up much higher than that in the very short term. And then I expect they very well might even go significantly below their 2021 revenues, possibly even before possibly reaching that endpoint. You know, it's who knows with natural gas prices, it's easily one of the most strangely volatile commodities. Either way, we have sales capital on expected basis of also 0.76. That is 76 cents in new revenue for each dollar of new capital invested in the business. That's effectively what that means. It's our sales capital efficiency function. And we come up with returns on invested capital on expected basis of 7.97%, which is a decline in returns on invested capital. And it's also not a very great return on invested capital, but it's also worth noting and reminding that the cost of capital that we came up with was about 7.5%. So even under this circumstance, they would still be earning returns on invested capital that exceed their cost of capital, i.e. they would have excess returns, as we call it. So debt to equity ratio, we have a distribution assumption of 62 to 63% and a default risk assumption based off of that of about 1.5%. A pretty consistent amount of default risk, but still not it's at least not too major on net. And we also have a profit margin distribution of anywhere from 5% to 14%. On expected basis, we see about 10.5%. And that gets us a profit distribution of anywhere from 1.6 billion to possibly 9.9 billion or almost 10 billion. On an expected basis, we see about 5 billion or so. That gets us a present value price after adjusting for the discount rate across the variety of outcomes of $26.76, which is 2% lower than the current share price. We have 5-year forward value targets unadjusted for the distributions that they'll pay out during the period of worst case scenario $15 and best case scenario $78.75. On expected basis, we see $41.02. And comparing that to the current share price, that gets us an implied return of 8.48% per year for the next 5 years. So not a very exciting return, definitely not the type of return that I would like to jump into a company at. So I'm definitely not interested in doing so. I do, however, think it's a very, very, very interesting company. I really wish that it was trading at a range the price would be more appealing at, because its industry is very much of interest to me. I like its overall corporate structure. I'm very much willing to take on an MLP structure myself if it means that that you can get excess returns due to holding it for a very long period of time. Even though, yes, it does mean you might have to deal with the kind of annoying extra filings come tax season. And I also am very much a fan of the fact that they have the very large insider holding and the low institution holding and a variety of other factors that shows pretty high demand for their industry moving forward. However, those returns just aren't there for it, at least not at this price. So definitely not interested at this point. So as I had kind of pointed out was, oh, hey, what's up, man? I see you in the chat there. As I pointed out before, the dividend itself makes up about 78% of the discount rate, which basically means that even at fair value, about 80% of your returns would just come from the distribution. You would not really expect to have any particular large amounts of capital appreciation from the stock in just in a general sense. You would only really expect 1 or 2 percentage points a year at fair value even to begin with. You know, I have a few people who claim to be my first viewer, you know, but of course I remember you. Your name is pretty memorable. So of course, but yeah, so that's gonna do it for EPD. Like I said, very interesting company. Happy to have it in the watch list. Definitely going to be passing on it for now. Coming over to the watch list, as I had shown, it's also value score 0.47 after taking in like worst and best case and relative cases into account. What does that kind of make it line up to against other stocks? That kind of puts it in the same line as, say, Starbucks or Dillard's or Ingalls Markets, or maybe a little bit worse than Google. So kind of in that range is where it falls in our overall watch list. I'm not entirely sure what we're going to be doing for the next valuation on Tuesday. I'm taking a look at a few other options. People who join the Discord can make suggestions there, as well as I've been looking through lots of 13Fs that have been released in the most recent few days or weeks or so, trying to look for different opportunities. So keep an eye out on for the notification of the future stream. I'll probably have that out within the near future. All right, so I'll catch you all again next time. Thanks. Oh, news on WBA. I haven't heard anything about WBA. Let me see. Have they moved pretty dramatically? Big drop. Let's see. Where are they on the watch list now? That's the question. Let's see. 0.84, 17%, 44.5. Let's pull them open. I'll take a look real quick. I'm curious. Did they report 5% drop? I mean, 5%, that's not too major, I guess. I don't know. It's something. Like I said, it looks to me like they're, at least based off of where my most recent valuation is, it looks like they might be undervalued. I might have to update those numbers though, so I'm not sure. It's possible that maybe I was a bit rosy when I made that valuation, but ordered to pay Ohio counties for opioid case. Ah, that's interesting. Okay, so there's a big court case. I don't know. Maybe I'll look into that later. But anyway, like I said, I'll catch you all again next time. If you are watching on the live or on the replay, please give us a like one last time before I go. I'll catch you all again next time. All right, bye.